Before we begin, a quick and important disclaimer. I am not a financial advisor, and this video is for educational and informational purposes only. The information presented here should not be taken as financial, legal, or tax advice. A home equity loan is a significant financial decision that involves risk, including the potential loss of your home if you fail to repay the loan. You should always consult with a qualified and licensed professional, like a financial advisor or mortgage broker, to discuss your specific situation before making any decisions. Now let's get into it. There is over $30 trillion in home equity sitting inside American homes right now. That's not a typo. $30 trillion. It's one of the largest, most underutilized sources of wealth in the entire country. And chances are, if you're a homeowner, a significant chunk of that wealth belongs to you. It's like having a secret savings account that grows every single time you make a mortgage payment, but the bank never gave you the PIN number. You feel the squeeze of inflation, you see the credit card bills with their insane 22% interest rate stack up. You dream about that new kitchen or paying for your kids' college, and all the while you are sitting on a potential solution locked inside the very walls of your house. The problem is, nobody ever taught us how to access it. Nobody ever handed us the key. This video is that key. We're going to pull back the curtain on one of the most powerful financial tools available to homeowners in the United States: the home equity mortgage. We're going to demystify it, break it down into simple, plain English, and give you the knowledge to determine if it's the right move for you. Forget the confusing bank jargon and the intimidating paperwork. By the end of this presentation, you will understand exactly what home equity is, how it works, and how you might be able to use it to radically change your financial picture. We're talking about a tool that can help you consolidate high-interest debt and save thousands of dollars a year. A tool that can fund major home renovations that not only improve your life, but also increase the value of your biggest asset. A tool that can cover unexpected emergencies, like a major medical bill or a new roof, without forcing you to drain your retirement savings. This isn't just about borrowing money. It's about strategic financial planning. It's about leveraging the asset you've worked so hard to build. For years, you've been diligently paying your mortgage, building this invisible wealth. Now it's time to learn how to make that wealth work for you. We are going to cover the two main types of home equity products: the home equity loan and the home equity line of credit, or HELOC. They sound similar, but they operate in fundamentally different ways, and choosing the wrong one can cost you dearly. Think of it like this: one is like getting a big, one-time check, and the other is like getting a powerful financial credit card with a much lower interest rate. We'll dissect the pros and the cons of each one with real-world examples, so you can see which one fits your specific goals. We'll also tackle the big questions head-on. How much can you actually borrow? What kind of credit score do you need? What are the banks really looking for when they approve these loans? We'll expose the hidden fees and potential pitfalls you absolutely must be aware of. Because let's be clear, this is a powerful tool, but like any tool, it has to be used correctly. Misusing it can have serious consequences, and my goal is to arm you with the information to use it wisely and responsibly. This isn't a get-rich-quick scheme. It's a guide to financial empowerment for the American homeowner. You see, the financial landscape has changed. Traditional personal loans have interest rates that can be crippling. Credit card debt is a trap designed to keep you paying forever. In this environment, understanding how to use your home equity isn't just a good idea. It's a financial necessity. It's about finding a smarter, more efficient way to manage your money. It's about taking control. You've earned this equity. It's yours. It represents years of hard work, sacrifice, and smart decision-making. Leaving it locked up, completely untouched, while you're paying 25% interest to a credit card company is like having a fire extinguisher while your kitchen is on fire and never pulling the pin. So, what exactly is this equity we keep talking about? It sounds like some abstract financial concept, but it's actually incredibly simple. It is the single most important number you need to know before we go any further, and calculating it is the first concrete step in this entire process. Home equity is simply the difference between what your home is currently worth on the market and the amount you still owe on your mortgage. That's it. It's the portion of your home that you truly own, free and clear. If your home is valued at $500,000, and you have a mortgage balance of $300,000, you have $200,000 in home equity. That $200,000 is the asset, the hidden savings account that we're going to learn how to tap into. But how do you figure out what your home is really worth today? Not what you paid for it, not what Zillow says in a rough estimate, but the number a lender will actually use to make their decision. And more importantly, how much of that equity will a bank actually let you borrow? They won't just hand you a check for the full $200,000. There's a critical concept called the loan-to-value ratio, or LTV, that determines everything. It's the gatekeeper to accessing your home's wealth. Understanding this one calculation is the difference between getting approved for the funds you need and getting a rejection letter in the mail. It dictates your borrowing power. So, before we dive into the differences between a loan and a line of credit, before we talk about interest rates and repayment plans, we need to build our foundation. We need to calculate your real, usable home equity and understand exactly how banks view your home as an asset. Let's break down that math step by step and find out exactly how much borrowing power you might be sitting on right now. Alright, let's get right into it. The first number we need is the big one. The current market value of your home. Now, your first instinct might be to pull up Zillow or Redfin, type in your address, and look at that big, bold number at the top of the page. And that's a perfectly fine place to start. It gives you a ballpark figure, a snapshot of what the algorithm thinks your home is worth today. But we have to be brutally honest here. That Zestimate is not the number a bank is going to use. Think of it as a well-educated guess. It's based on public data, recent sales in your area, and market trends. It can be surprisingly accurate, or it can be wildly off, sometimes by tens of thousands of dollars. I once worked with a homeowner whose Zestimate was nearly $50,000 higher than what the house was actually worth. Why? The algorithm saw a recent sale of a completely renovated home down the street and assumed his house had the same brand new kitchen and spa-like bathroom. It didn't. This is why lenders don't rely on these online tools. For them, the only number that matters is the one on a professional appraisal report. An appraiser is a licensed professional who physically comes to your home. They walk through every room, they measure the square footage, they note the condition of your roof, your HVAC system, your appliances. They look at the quality of your finishes, the layout, the curb appeal. Then they do what the algorithm tries to do, but with a human eye for detail. They find the 3 or 4 most comparable homes, we call them comps, that have sold in your immediate neighborhood within the last few months. They then make specific dollar-for-dollar adjustments. Does the comp have a swimming pool and you don't? They'll subtract the value of a pool. Did you add a deck last summer? They'll add value for that. The final number they come up with is the official bank-accepted fair market value of your property. For our purposes today, you can start with an online estimate, but just keep in the back of your mind that the bank's final number will come from an appraisal they will order. So, for our example, let's grab a nice round number. Let's say the fair market value of your home is determined to be $500,000. Write that number down. Step 1 complete. Step 2 is much easier. We need to know your current mortgage balance. This isn't a guess. This is a hard number. You can find it instantly by logging into your mortgage provider's online portal. It's usually right there on the dashboard. You can also find it on your most recent monthly mortgage statement. It will be clearly labeled as the principal balance. It's simply what you still owe on your original home loan. Let's say for our $500,000 home, you've been paying it down for a while, and your remaining mortgage balance is $200,000. Write that number down right next to your home's value. Now for the magic, the basic equity calculation. This is the part that gets homeowners excited. You take the market value of your home and subtract what you owe on your mortgage. So, in our example, $500,000 minus $200,000 equals $300,000. That's your total home equity, $300,000. It's a powerful number. It represents the portion of your home that you truly own, free and clear. It's the wealth you've built payment by payment, year by year. It's a financial asset that, on paper, is worth a substantial amount of money. And this is where many people stop. They see that number and think, great, I have $300,000 I can borrow against. But this is where we separate the amateurs from the pros, because that $300,000 is not your borrowing power, just your total equity. To find the amount a bank will actually let you touch, we need to understand the single most important concept in home equity lending: the loan-to-value ratio, or LTV. This is the bank's secret formula. They have a hard limit on how much total debt they're comfortable having on a single property. They will never ever let you borrow 100% of your home's value. Why? Risk. Imagine if they did, and the housing market took a slight dip. Suddenly, you would owe more on the house than it's worth. You'd be underwater. If you had to sell, you wouldn't even get enough to pay back your loans. That's a disaster for you, and it's a huge loss for the bank. So, to protect themselves, they create a safety cushion. This cushion is the LTV. Most lenders cap their maximum allowable combined loan-to-value, or CLTV, at either 80 or 85%. This means the total of all loans against your home, your main mortgage plus your new home equity loan, cannot exceed 85% of its appraised value. Let's go back to our example. Your home is worth $500,000. The bank's maximum allowable LTV is 85%. So, the first thing we do is calculate what that 85% is. 500,000 multiplied by 0.85 gives us $425,000. This is the magic number. This is the absolute maximum debt the bank is willing to see on your property, period. But you already have some debt, right? You have your existing mortgage. So the final step is to take that maximum allowed debt, $425,000, and subtract your existing mortgage balance, which was $200,000. $425,000 minus $200,000 equals $225,000. Now look at that number. $225,000. That is your real, usable, accessible equity. That is the maximum amount you could potentially borrow. Notice how different it is from the $300,000 of total equity we calculated earlier. It's $75,000 less. That difference is the bank's safety net. It's the portion of your equity they essentially lock away to protect themselves and, frankly, to protect you from over-leveraging yourself. This 80 or 85% figure isn't always set in stone. It's a benchmark. If you have a stellar credit score, say 780 or higher, and a very low debt-to-income ratio, some lenders might stretch to 90% in a competitive market. On the other hand, if your credit is a bit bruised or you have a lot of other debt, they might pull back to 75 or 80%. The strength of your overall financial profile directly impacts how much of your own equity a lender will trust you with. So take a moment and do this math for your own situation. Use an estimated home value. Subtract your mortgage balance to get your total equity. Then, multiply your home's value by 0.85 to find the bank's likely maximum loan amount. Finally, subtract your mortgage balance from that number. The result is a realistic estimate of your personal borrowing power. Now you know the number. This isn't a vague idea of wealth anymore. It's a concrete figure that represents a powerful financial tool at your disposal. You know how much you're working with, but this immediately brings up the most critical question of all. Now that you have this borrowing power, how should you use it? Because there are two fundamentally different ways to tap into this equity, and they are not created equal. One is a lump sum loan with a fixed interest rate and a predictable monthly payment, like a car loan. The other is a flexible line of credit with a variable interest rate that acts more like a credit card. This is the home equity loan versus the home equity line of credit, or HELOC. One offers stability, the other offers flexibility. And choosing the wrong one for your specific goal can cost you thousands of dollars and create a massive financial headache. So we need to put these two products head to head. We'll stage a financial showdown to see which one is the champion for different needs, from home renovations to debt consolidation to funding a new business. It's a battle of the fixed versus the flexible, and picking the winner for your situation is the next crucial step in this journey. So let's dive right into that ring and meet our two contenders. In one corner, we have the heavyweight champion of predictability, the home equity loan, or HELOC. And in the other corner, the agile and adaptable challenger, the home equity line of credit, the HELOC. They both step into the ring with the same power source, your home's equity, but their fighting styles are worlds apart. First up, the home equity loan. Think of this as the straightforward, powerful slugger. It's simple, direct, and you always know what punch is coming next. When you get a home equity loan, the bank gives you a single lump sum payment. Let's say you're approved for $75,000. That entire amount is deposited into your bank account, ready to use. From that moment on, you have a loan with a fixed interest rate and a fixed repayment term, typically anywhere from 5 to 30 years. This means your monthly payment, principal and interest, is the exact same amount on day one as it is in year 10. It's predictable. It's stable. It's the very definition of financial consistency. This structure makes budgeting a breeze. You know precisely how much you owe and for how long. There are no surprises, no sudden rate hikes that will throw your entire financial plan into chaos. So, when is this powerful, predictable champion the right choice? It's perfect for large, one-time expenses where you know the exact cost up front. The classic example is a major home renovation. You've gotten a quote from a contractor for $50,000 to build that new addition. A home equity loan gives you that exact $50,000. You pay the contractor, and you start paying back your loan with a payment you can count on. Another prime use case is debt consolidation. Imagine you have $25,000 in high-interest credit card debt spread across 3 different cards, each with a variable interest rate hovering around a painful 22%. You could take out a home equity loan for $25,000 at a much lower, fixed interest rate, say 7 or 8%. You use that lump sum to pay off all those credit cards in one fell swoop. Suddenly, instead of 3 unpredictable, high-interest payments, you have one single, manageable, and much cheaper monthly payment. You've traded financial chaos for calm. But the slugger has weaknesses. The biggest drawback of a home equity loan is its lack of flexibility. You get all the money at once and you start paying interest on the entire amount immediately, whether you've spent it or not. If your $50,000 renovation ends up only costing $45,000, you're still paying interest on that extra $5,000 you didn't need. And what if the opposite happens? What if workers open up a wall and find an unexpected problem that costs an extra $10,000? You can't just go back and ask for a little more from your loan. You'd have to apply for a whole new loan, which is a massive headache. With a HELOC, you have to get your numbers right from the very beginning. Now let's turn our attention to the other corner of the ring, the home equity line of credit, or HELOC. If the HELOC is a powerful slugger, the HELOC is a nimble, strategic fighter. It's all about flexibility, adaptability, and reacting to changing needs. A HELOC doesn't give you a lump sum of cash. Instead, it gives you access to a revolving line of credit, much like a credit card. The lender approves you for a maximum credit limit, say $100,000, based on your equity. But you don't have to use any of it. It just sits there waiting. You can draw money from it as you need it, up to your limit, using a special checkbook or a debit card linked to the account. This is where the HELOC's brilliance shines. You only pay interest on the amount you've actually used. If you have a $100,000 line of credit but have only drawn $20,000 for a bathroom remodel, you're only making payments and accruing interest on that $20,000, not the full amount. HELOCs are typically structured in 2 phases. The first is the draw period, which usually lasts about 10 years. During this time, you can borrow from and pay back the line of credit as often as you like, similar to a credit card. For many HELOCs, the payments during this period are interest only, which keeps them very low and manageable. Then, after the draw period ends, you enter the repayment period, which can last from 10 to 20 years. At this point, you can no longer borrow from the line of credit. Your outstanding balance is converted into a regular loan, and you start making payments that include both principal and interest until it's paid off. The biggest trade-off for all this incredible flexibility is the interest rate. Unlike the fixed-rate HELOC, most HELOCs have a variable interest rate. This rate is tied to a benchmark index, like the prime rate set by the Federal Reserve. So, if the Fed raises interest rates to combat inflation, the rate on your HELOC will go up too, and so will your monthly payment. This uncertainty can make long-term budgeting more challenging. One month your interest-only payment might be $200, but if rates climb, it could become $300 or $400 a few months later. So when is this flexible contender the right choice? A HELOC is ideal for situations where costs are ongoing, unpredictable, or spread out over time. Think of a series of home improvement projects you plan to tackle over the next few years. New roof this year, new windows next year, landscaping the year after. A HELOC allows you to pay for each project as it comes without having to take out a new loan each time. It's also an incredible tool for covering recurring major expenses, like college tuition. Instead of taking out a massive loan up front, you can simply draw the exact amount you need for tuition and fees each semester. And perhaps its most powerful use is as a financial safety net. Having a HELOC open, even with a zero balance, is like having a massive emergency fund on standby. If the furnace dies in the middle of winter or you have an unexpected medical bill, you have immediate access to cash at a much lower interest rate than a credit card or personal loan. You don't pay a dime for it until you actually use it. Let's put them head-to-head in a real-world scenario. Meet the Davis family. They want to completely gut and remodel their kitchen. They've met with a contractor and have a firm quote for $62,000. They are on a tight monthly budget and value predictability above all else. For the Davises, the home equity loan is the undisputed champion. They get the exact $62,000 they need, and their monthly payment will be the same for the next 15 years. No surprises, no stress. Now meet the Garcias. Their oldest child is starting college, and they need to cover tuition for the next 4 years. They also know their roof is getting old and might need replacing sometime in the next few years. They aren't sure of the exact costs or timing for any of this. For the Garcias, the HELOC is a knockout winner. They can draw funds for tuition each semester, and if the roof suddenly starts leaking, they have instant access to the money to fix it without derailing their finances. The flexibility is perfectly matched to their uncertain, ongoing needs. So the choice really comes down to a single question. Are you funding a known one-time project, or are you preparing for unknown ongoing expenses? If your answer is the first, the stability of a home equity loan is likely your best bet. If it's the second, the flexibility of a HELOC is almost certainly the superior tool. It's about matching the financial product to your specific life situation. The powerful, predictable slugger or the nimble, adaptable strategist? Understanding their core differences is the key to unlocking the wealth in your home wisely. Now that you can see the clear difference between these two financial heavyweights and can probably already see which one might fit your needs, the next big question is, how do you actually qualify for one? What are the secret numbers and criteria that lenders are looking at when they decide whether to give you the keys to your equity? We're pulling back the curtain on the approval process next. Alright, let's get right into it. The approval process for a home equity loan isn't a mysterious ritual conducted in a secret back room. It's a formula. And once you understand the formula, you can figure out exactly where you stand before you even talk to a lender. Think of it as the lender's 4-part stress test for your financial life. Pass these 4 tests and the money is yours. Fail even one and that door to your equity slams shut. The first and most important number, the one that acts as the gatekeeper to this entire process, is your credit score. This 3-digit number is your entire financial history boiled down to a single grade. To a lender, it's not just a number. It's a prediction. It's their crystal ball for figuring out one simple thing. How likely are you to pay them back? A high score says you're reliable, a financial all-star. A low score screams risk, flashing red warning lights all over your application. So what's the magic number? While you might see ads promising loans for scores in the low 600s, the reality is that the floor is usually a 620 FICO score. And even then, you're on thin ice. Getting approved with a score that low often means you'll be hit with a painfully high interest rate to compensate the lender for the risk they're taking. The real game begins around a 680. This is where you move from being a subprime borrower to a prime one. But the sweet spot, the number that gets you the best rates, the quickest approvals, and the most favorable terms is typically 720 or higher. Let me put this in real dollar terms. Imagine you want a $75,000 home equity loan. With a 740 credit score, you might get an interest rate of, say, 7.5%. But with a 640 score, that rate could easily jump to 10.5% or even higher. Over the life of a 15-year loan, that 3-point difference isn't just a few bucks. It's over $30,000 in extra interest payments. $30,000. All because of that one number. Your credit score isn't just a pass-fail test. It's a dial that controls how much this loan will actually cost you. Now, assuming your credit score is in the right ballpark, we move to the second pillar, and it's the one that gives this loan its name, your equity. You can have a perfect 850 credit score, but if you don't have enough equity, you get nothing. Lenders look at this through a lens called the combined loan-to-value ratio, or CLTV. This sounds complicated, but it's just simple math that protects the bank. Here's how it works. First, they take your current mortgage balance and add the amount of the home equity loan you want. That's your combined loan amount. Then they divide that total by the current appraised value of your home. The result is your CLTV. Most lenders have a hard and fast rule. Your CLTV cannot exceed 85%. Some are even more conservative and cap it at 80%. Why? Because they need a safety cushion. If you default on your loans and the bank has to foreclose, they know they'll lose money selling the house. They have to pay real estate commissions, legal fees, and deal with a potential drop in the market. That 15 to 20% cushion of your equity is their insurance policy. Let's walk through an example. Let's say your home is currently worth $500,000. You have an outstanding mortgage balance of $280,000. You want to take out a $70,000 home equity loan for a new kitchen. Your combined loan amount would be your $280,000 mortgage plus the new $70,000 loan, for a total of $350,000. Now we divide that $350,000 by your home's value of $500,000. The result is 0.7, or a CLTV of 70%. You are well under the 85% limit. You've passed the second test with flying colors. But what if you wanted $100,000 instead? Your combined loan would be $380,000. Divide that by $500,000 and your CLTV is 76%. Still good. But what if your home was only worth $450,000? Now that same $380,000 in debt gives you a CLTV of almost 85%. You're right on the edge. Any lower home value or higher loan request and the bank says no. This calculation is non-negotiable. It's the single biggest factor in determining how much you can actually borrow. Okay, so you've got the credit and you've got the equity. The bank is interested. But now they need to answer the most pressing question of all. Can you actually afford to make another monthly payment? This is where the third pillar comes in, your debt-to-income ratio, or DTI. DTI is the ultimate financial stress test. It compares how much money you have coming in each month to how much you have going out to pay off debts. Specifically, lenders look at your back-end DTI. This includes all of your monthly debt obligations, your primary mortgage payment, property taxes, homeowners insurance, car payments, student loans, credit card minimum payments, and of course the estimated payment for the new home equity loan you're applying for. They add all of that up and divide it by your gross monthly income. That's your income before taxes are taken out. The magic number here for most lenders is 43%. If your total monthly debts, including the new loan, make up more than 43% of your gross monthly income, alarm bells start ringing. You are seen as over-leveraged, meaning a single unexpected event, a job loss, a medical bill, could push you into default. Some lenders might stretch to 45% or even 50% if you have a massive amount of cash in savings and a very high credit score, but 43% is the industry standard line in the sand. Let's run the numbers. Say you and your spouse have a combined gross monthly income of $10,000. Your current mortgage payment is $2,200. You have 2 car payments totaling $800 and student loan payments of $400. That's $3,400 in existing debt. The new home equity loan you want will have a monthly payment of about $600. Your new total monthly debt would be $4,000. Divide that $4,000 by your $10,000 income, and you get a DTI of 40%. You're in the clear. But if that same couple had an extra $500 in credit card payments, their DTI would jump to 45%, and the loan approval would suddenly be in jeopardy. DTI is the affordability check. It ensures you're not biting off more than you can financially chew. Finally, we arrive at the fourth pillar, stable and verifiable income. The numbers are meaningless if you can't prove they're real and that they're going to continue. This isn't just about how much you make. It's about how you make it and for how long. The gold standard for a lender is a W-2 employee with at least a 2-year history at the same job or, at the very least, in the same line of work. This tells them you're stable. You're not a flight risk. To prove this, you'll need to hand over your last 2 pay stubs, your last 2 years of W-2s, and sometimes your last 2 tax returns. They will verify this information. They will call your employer. They are looking for consistency. Now, for all the entrepreneurs, freelancers, and self-employed people watching, this part can be a little trickier, but it's far from impossible. You don't have W-2s, so your tax returns become the holy grail. Lenders will typically want to see your last 2 years of complete personal and business tax returns. They will average your net income over those 2 years to determine your qualifying income. The key here is documentation. You'll need profit and loss statements, bank statements, and a well-organized financial picture. You have to prove to them that your income, while maybe not as predictable as a salaried employee's, is consistent and reliable over the long term. So there you have it. The 4 pillars of home equity loan approval. A solid credit score, a CLTV under 85%, a DTI under 43%, and a stable verifiable income. It's not a mystery, it's a checklist. And understanding this checklist gives you the power. You can run these numbers yourself right now and know with a high degree of certainty whether you'll be approved. But getting approved is only half the battle. Once you submit that application, a whole new process begins. One filled with appraisals, underwriting, and a mountain of paperwork. What are the hidden fees that can pop up and cost you thousands? How long does this whole process actually take from start to finish? And what are the critical mistakes people make during the application that get their loan denied, even after a pre-approval? We are diving deep into the application and closing process itself, showing you how to navigate it like a pro right after this. So you've got your pre-approval letter in hand. You feel invincible. You've been given the green light, the golden ticket. The bank has looked at your initial numbers and said, yeah, this looks good. But here's the terrifying truth that most people don't realize until it's too late. The pre-approval is not a promise. It's an invitation to a high-stakes game. And from this moment until the day you sign the final papers, you are walking through a minefield. One wrong step and the whole thing blows up. The most heartbreaking calls I get are from people who were denied a loan after being pre-approved because they made one of a handful of critical, avoidable mistakes. This is where the dream of a new kitchen or a consolidated debt-free life can turn into a nightmare of rejection. The first stage is the formal application itself. Think of this as your sworn testimony. When you filled out the pre-approval, you were sketching a picture. Now the lender is handing you a magnifying glass and a fine-tipped pen and telling you to paint a masterpiece of financial honesty. Every blank must be filled. Every number must be precise. Your income isn't about $75,000. It's $74,852.16, or whatever it says on your pay stub. You can't forget about that old store credit card with the $2,000 balance. In the digital age, lenders see everything. They will pull your credit, they will verify your employment, they will scrutinize your bank statements. A small inconsistency, a tiny white lie, it doesn't just look like a mistake. To an underwriter, it looks like a red flag. It looks like fraud. And it's the fastest way to get your file stamped denied. Your job here is to be an open book because they have the power to read every single page anyway. Once the application is in, the great flood begins. This is what we call the paperwork tsunami. The lender will ask for documents and they will keep asking. You'll need your last 2 years of W-2s. Your last 2 years of federal tax returns, all pages. Your last 2 months of bank statements, all pages. Your most recent 30 days of pay stubs. Your driver's license, your homeowner's insurance declaration page. If you're self-employed, it's even more intense. Profit and loss statements, balance sheets. The key to surviving this is preparation and speed. Before you even apply, create a folder on your computer. Scan and save everything as a PDF. Name the files clearly. When your loan officer emails you at 10 a.m., asking for your latest bank statement, don't wait until after dinner to send it. Send it at 10:05 a.m. Why? Because you are in a queue. Every loan application at that bank is in a line waiting for review. The faster you provide what they need, the faster your file moves to the next stage. A delay of a day on your end can mean a delay of a week on their end. And in a volatile interest rate market, that week could cost you thousands of dollars if your rate lock expires. Be organized, be responsive, be fast. Now, for the most important part. Once your application is submitted and you're in the process, you enter what's known as the quiet period. This is the minefield I was talking about. Your financial life needs to be frozen in carbonite. The lender pre-approved the person they saw on that initial application. Your job is to remain that exact same person until the loan is closed. Any significant change can shatter the foundation of their approval. So here are the cardinal sins, the absolute do-nots of the quiet period. First, and this is the biggest one, do not apply for new credit of any kind. I don't care if the furniture store is offering 0% financing for 5 years on a new sofa. I don't care if you get a pre-approved offer for an amazing travel rewards credit card. Do not apply. Every time you apply for credit, it triggers a hard inquiry on your credit report, which can ding your score. But more importantly, it adds a new monthly payment to your debt-to-income ratio. If your DTI was already borderline, that new $200 a month car payment you just took on could be the single thing that pushes you over the edge and disqualifies you. The lender will run your credit again, sometimes multiple times, right before closing. They will see it. Don't do it. Second, do not make any large, undocumented cash deposits into your bank accounts. This is a massive red flag for underwriters. A random $5,000 cash deposit looks like a secret, undisclosed loan from a friend or family member, which is a liability they haven't accounted for. Or worse, it could be a sign of money laundering. All sources of funds must be sourced and seasoned, meaning the lender needs to know where it came from and see that it's been in your account for a while. If your parents are gifting you money, that's fine, but it needs to be documented with a proper gift letter. Selling your car? Great, you'll need the bill of sale. If you're a waiter who gets paid in cash tips, that's fine too because it's part of your documented income pattern. But a big one-time unexplained cash deposit? It's a deal killer. Third, don't change jobs. I know sometimes you get an offer you can't refuse. If you absolutely have to, you need to talk to your loan officer immediately. A job change, even to a higher-paying job, introduces instability into the equation. Lenders love stability. They love to see a 2-year history at the same company. If you move from a salaried W-2 job to a commission-based or self-employed role, your loan is almost certainly dead on arrival. They can't verify your new income. If it's a similar W-2 job in the same industry with a higher salary, you might be okay, but it complicates everything and will cause delays. If you can just wait until after you close. Fourth, don't miss any payments on your existing debts. This seems obvious, but people get distracted during the stress of the loan process. Set all your bills to autopay. A single 30-day late payment on a credit card or car loan that pops up mid-process can crater your credit score and get you denied at the final hurdle. And finally, don't spend your savings. The money you listed as assets on your application needs to stay there. Lenders want to see that you have reserves, a financial cushion. If they see your savings account being drained to buy a new big screen TV or book a vacation, they get nervous. It signals financial irresponsibility. If you can avoid these mistakes, you've navigated the majority of the minefield. The next major event is the appraisal. The lender will hire an independent, licensed appraiser to determine the current market value of your home. This is judgment day. The entire loan is contingent on your home being worth enough to support the loan amount. The appraiser will walk through your home, take pictures, measure rooms, and note the condition and any upgrades. Then they will pull data on recently sold, comparable homes in your neighborhood, the comps, to arrive at a final value. If the appraisal comes in at or above the value you need, you breathe a huge sigh of relief. But what if it comes in low? Don't panic. You have options. You can challenge the appraisal by providing your own, better comps that the appraiser may have missed. You can sometimes get a second appraisal, or you may have to reduce the amount you're borrowing. This is a critical moment, but a low appraisal isn't always the end of the road. After the appraisal is in, your complete file application documents appraisal goes to the final boss, the underwriter. The underwriter's job is to look at your entire financial story and make one decision. Is this an acceptable risk for the bank? They are the ultimate gatekeeper. They will re-verify everything. They might come back with questions or requests for more documents, which are called conditions. It could be a letter of explanation for a past credit issue, or a more recent pay stub. Again, speed is your ally. Answer their questions and provide the documents immediately. Once the underwriter is satisfied and has cleared all conditions, you'll get the 3 most beautiful words in the English language: clear to close. At this point, you'll be issued a closing disclosure or CD. This is a standardized document that lays out, in black and white, all the final details of your loan. The interest rate, the monthly payment, the closing costs, everything. By law, you must receive this document at least 3 business days before you can sign your final loan papers. Use this time. Read every single line. Compare it to the loan estimate you received at the beginning. Make sure the numbers match and that there are no surprises. If you see something you don't understand, ask your loan officer immediately. Finally, you arrive at the closing table. You'll sit with a closing agent or attorney and sign a mountain of paperwork. But here's one last crucial piece of protection you need to know about. For a home equity loan or a HELOC on your primary residence, you have a 3-day right of rescission. This means that after you sign everything, you have 3 business days to change your mind and cancel the entire transaction with no penalty. It's a federally mandated cooling-off period. The clock starts the day after you sign. So if you sign on a Monday, you have until midnight on Thursday to back out. This is your final safety net. Navigating this process feels like a marathon, but by understanding the map and knowing where the mines are buried, you can cross the finish line without a scratch. But now the real question emerges. The money is in your account. The power is in your hands. How do you wield it? Because getting the loan is only half the battle. Using it wisely is what separates financial success from a decade-long debt trap. What are the smartest strategies for deploying your home's equity? And what are the hidden behavioral traps of a HELOC draw period that can keep you paying interest-only payments forever, never touching the principal? We'll break down the ultimate user's guide to your new financial tool in the very next part. So let's pull back the curtain on the HELOC draw period. Think of it as the HELOC's honeymoon phase. For a set amount of time, typically 10 years, the bank hands you a checkbook and a debit card tied to a massive line of credit and says, "Have fun." During this period, you can borrow money, pay it back, and borrow it again up to your credit limit as many times as you want. It's the ultimate financial flexibility. And here's the seductive part. During this entire draw period, you are often only required to pay the interest on the amount you've borrowed, not a single penny of principal. And that, right there, is the door to the first and most dangerous behavioral trap, the illusion of cheap money. Imagine you have a $100,000 HELOC. You decide to finally do that kitchen remodel you've been dreaming of and you draw $50,000. Let's say your interest rate is 7%. Your required monthly payment isn't based on paying that loan back over 15 or 20 years. No, your minimum payment is just the interest. So $50,000 times 7% divided by 12 months, your payment is about $291. $291 a month for a brand new $50,000 kitchen. Feels like a magic trick. Feels impossibly cheap. Your brain, conditioned to associate large purchases with large monthly payments, gets a signal that this debt isn't that serious. It's just a small monthly bill, like a streaming service subscription or a cell phone plan. This low payment makes it psychologically effortless to justify borrowing more. A few months later, the air conditioner dies. That's a $10,000 expense you didn't plan for. Instead of dipping into your emergency fund, that HELOC is just sitting there, whispering your name. So you draw another $10,000. Now your balance is $60,000. Your new interest-only payment? It only goes up to about $350. Still incredibly manageable. You've just borrowed 60 grand and your monthly obligation is less than a typical car payment. This is the trap in action. You're not feeling the true weight of the debt you're accumulating. This leads directly into the second behavioral trap, the minimum payment mindset. We've all been trained by credit card companies for decades to look for that minimum payment due box on our statement. We know intellectually that it's a bad idea to only pay the minimum on a credit card, but it's an option for a reason. With a HELOC in its draw period, the interest-only payment is the minimum payment. The system is designed to encourage this behavior. You make the payment, you're in good standing. But what you're really doing is renting the bank's money, month after month, year after year, without ever actually reducing the amount you owe. You're on a financial treadmill, running hard just to stay in the same place. After 5 years of making $350 payments on that $60,000 balance, you know how much you'll owe? $60,000. You've paid over $20,000 in interest and made zero progress. This is where the real danger sets in. Because the draw period feels so long, 10 years feels like an eternity, there's no sense of urgency. You think, I'll start paying down the principal next year when I get that raise. But life happens. The car needs new tires. The kids need braces. A once-in-a-lifetime vacation opportunity comes up. And that flexible, cheap HELOC is always there, ready to fund it. Before you know it, 8 years have passed, your balance has crept up to $85,000, and you've never made a single payment towards the principal. Then the honeymoon is over. The draw period ends, and you get hit by what the industry calls payment shock. This is the moment the trap springs shut. The bank freezes your line of credit. You can no longer borrow from it, and your payment structure changes overnight. You are no longer allowed to pay interest only. Your loan is converted into a fully amortizing loan, meaning your new payment is calculated to pay off the entire balance, all the principal plus the future interest, over the remaining term of the loan, which is typically 15 or 20 years. Let's go back to our example. You have an $85,000 balance. Your 10-year draw period is over, and now you have a 20-year repayment period. Your interest-only payment of about $495 a month is gone forever. Assuming that same 7% interest rate, your new required fully amortized payment is now calculated. It jumps to approximately $659 a month. That's a 33% increase in your monthly payment, instantly. But wait, it gets worse. Remember, most HELOCs have a variable interest rate. Over the 10 years of your draw period, it's very likely that interest rates in the general economy have changed. If the prime rate has gone up, your rate has gone up with it. So let's say rates have risen and your 7% HELOC is now at 9.5%. Your new payment on that $85,000 balance isn't $659. It's now $803 a month. Your payment has just gone from under $500 to over $800. It has essentially 60% upped, and you have no choice but to pay it. This is the payment shock that has blindsided countless homeowners. They coasted for a decade on easy, low payments, only to face a financial cliff at the end of it. So how do you use this powerful tool without falling into the trap? This is the ultimate user's guide to your new financial superpower. Rule number 1. Treat it like a project loan, not a slush fund. Before you ever draw a dime, you must have a specific purpose, a specific budget, and a specific end date. You are using it for a $50,000 kitchen remodel. Period. You will draw only the money needed for that project, and when the project is done, you stop. You don't open a HELOC just in case, or for financial flexibility. That's an invitation for lifestyle creep, funding consumption with your home's equity. Rule number 2. Completely ignore the interest-only minimum payment option. It's poison. From your very first payment, you should be paying both principal and interest. The best way to do this is to ask your lender, or use an online calculator, to tell you what the fully amortized payment would be over, say, a 15-year term. Then, you voluntarily pay that higher amount every single month right from the start. This does two things. First, you're actually reducing your debt and building equity. Second, you completely eliminate the threat of payment shock because you've been paying the shock payment all along. Rule number 3. Use it for assets, not ashes. The wisest use of a HELOC is for things that can potentially increase your net worth. This includes value-adding home renovations, consolidating high-interest credit card debt into a lower-rate loan, or funding a business or education that will increase your earning power. The worst use is for things that are consumed and disappear, leaving only the debt behind. Vacations, fancy dinners, clothes, cars. Borrowing from the equity in your home, a long-term appreciating asset, to pay for short-term, depreciating lifestyle choices is a recipe for financial ruin. This is the fundamental difference in mindset between a HELOC and a traditional home equity loan. A home equity loan enforces discipline upon you. You get a lump sum of cash, and from day one you have a fixed payment of principal and interest for a fixed number of years. Simple, predictable, and boring in a good way. A HELOC gives you all the rope in the world. It's up to you to use it to build something, not to get tangled up in it. By understanding these behavioral traps and committing to these rules, you transform the HELOC from a potential danger into one of the most powerful and effective financial tools a homeowner can possess. You've mastered the psychology. You know the rules of the road. But how do you actually get one? What are the banks really looking for when they stare at your application? What's the magic number for your credit score? And how much debt to income is too much? We're pulling back the curtain on the underwriting process next. So let's pull back that curtain. The entire process from the moment you click apply to the day the money hits your account is governed by one word: risk. To the lender, you are not a person with a dream of a new kitchen. You are a risk profile. And the underwriter? Their job is to calculate just how big of a risk you are. They are the financial detectives, the gatekeepers of the bank's vault, and their entire job is to answer one question. If we lend this person tens or even hundreds of thousands of dollars, what are the odds we'll get it back with interest? To do that, they don't use a crystal ball. They use a framework, and it's a framework you need to understand inside and out. It's often called the 3 C's of credit: capacity, credit, and collateral. Master these and you'll walk into any application with confidence. Let's start with the first C, capacity. This is the big one. It's not about how much money you have in the bank right now. It's about your ability to handle another monthly payment. The key metric here is something you've probably heard of, but maybe never fully understood: your debt-to-income ratio, or DTI. It's a simple but brutal calculation. The bank adds up all of your monthly debt payments, your primary mortgage, car loans, student loans, minimum credit card payments, any personal loans, everything that shows up on your credit report. Then they divide that total by your gross monthly income, which is what you make before taxes. Let's make it real. Say you and your spouse bring in a combined $10,000 a month before taxes. Your mortgage is $2,500. You have 2 car payments totaling $900. And your minimum credit card payments add up to $200. Your total monthly debt is $3,600. So, you take $3,600, divide it by your $10,000 income, and you get 0.36. Your DTI is 36%. Now, what's the magic number? For most lenders, the absolute ceiling is 43%. If your existing debts, plus the new proposed home equity payment, push you over that 43% mark, it's an automatic red flag. The computer will likely spit your application right out. The sweet spot? Lenders love to see a DTI under 36%. It shows them you have breathing room. It shows them that if an unexpected expense pops up, you won't have to choose between paying your car loan and paying them. They will verify your income relentlessly. They'll want your last 2 years of W-2s, your most recent pay stubs, and sometimes even your tax returns. They are building a case that you have a stable, reliable capacity to repay the loan. Next up, the second C, credit. This is your financial report card. It's the story of how you've handled debt your entire adult life. Your credit score is the headline of that story. While you can sometimes get a home equity loan with a score in the mid-600s, it's going to be tough, and the interest rate will be high. The real doors start opening up when you cross the 700 threshold. And if you're sitting with a score of 740 or higher, lenders will be competing for your business. But the underwriter looks deeper than just the 3-digit number. They pull your full credit report and they read it like a novel. They're looking for a few key things. First, payment history. Do you pay your bills on time every time? A single 30-day late payment in the last year can be a major issue. Second, they look at your credit utilization. Are your credit cards maxed out? That signals financial stress. Ideally, you want to be using less than 30% of your available credit. And third, they're looking for major derogatory events. Bankruptcies, foreclosures, collections. These are the scarlet letters of the financial world, and you'll need to have a very good explanation and a lot of time passed since they occurred. A pro tip: a few months before you even think about applying, get a free copy of your credit report from all 3 bureaus. Comb through it for errors, a mistake, a debt that isn't yours, a late payment that was actually on time. Could be the difference between approval and denial. Clean it up before the underwriter sees it. And that brings us to the third, and arguably most important C for this type of loan: collateral. This is your home. It's the ace up your sleeve. It's the security that makes the bank willing to take this risk in the first place. Because if everything goes wrong, you lose your job, you can't make the payments, the bank knows they can ultimately foreclose on the property to get their money back. But they'll only lend you money if there's enough value in the home to make it worth their while. This is where we talk about combined loan-to-value, or CLTV. Let's break that down. Your home gets appraised for $500,000. You still owe $300,000 on your first mortgage. Now, you want to take out a $75,000 home equity loan. The underwriter will add your existing mortgage, $300,000, and the new loan, $75,000, together, for a total of $375,000. They divide that by the home's value of $500,000. Your CLTV is 75%. Most lenders will not go above an 85% CLTV. Why? Because that remaining 15% is their safety cushion. They know that if they have to foreclose, there will be legal fees, realtor commissions, and the risk that the house sells for less than its appraised value. That 15% equity buffer protects them from losing money. And they are not taking your word on what your house is worth. They will order a full independent appraisal. A licensed professional will come to your home, measure it, take pictures, compare it to recent sales in your neighborhood, and deliver an official valuation report directly to the lender. This appraisal is a critical moment. If it comes in lower than everyone expected, the amount you can borrow will be reduced, and in some cases it can kill the deal entirely. So you've got the 3 C's down. Your capacity is strong, your credit is clean, and you have plenty of collateral. What happens next? You'll start by gathering your documents. Think of it as building your case file. 2 months of bank statements, 30 days of pay stubs, 2 years of W-2s, a copy of your homeowner's insurance policy, and your most recent mortgage statement. You'll fill out the application, which is a formal declaration of your assets, liabilities, and income. Be scrupulously honest. The underwriter's job is to verify everything, and if they find a discrepancy, they will assume the worst. Once submitted, the file goes into underwriting. A human being will now review every single document you provided. They will run your credit. They will order the appraisal. They will order a title search to make sure there are no other liens on your property. And they may come back with questions, what they call conditions. Can you explain this large, unusual deposit into your checking account 3 months ago? We see a credit inquiry from a car dealership last week. Did you take on a new loan? Your job is to answer them quickly and provide any requested documentation. This process can feel invasive, can feel like you're being put under a microscope, and you are. But it's not personal. It's just the bank's process for managing risk. Once the underwriter has satisfied all conditions, the appraisal is back and looks good, and the title report is clear, they will issue the magic words, clear to close. From there, you'll schedule a closing, sign a mountain of paperwork, and then the money is yours. For a home equity loan, it's typically wired to your account after a federally mandated 3-day right of rescission period, which gives you a last chance to back out. For a HELOC, your line of credit becomes active, and you'll receive a checkbook or a debit card to access your funds. You've navigated the maze. You've satisfied the underwriter. You're approved. But here's where so many people make a critical and incredibly costly mistake. They're so relieved to be approved that they take the very first offer they get from the very first lender they spoke to. They leave thousands, sometimes tens of thousands of dollars on the table over the life of the loan. How do you avoid this? How do you shop for a home equity loan like a pro? How do you actually pit lenders against each other to get the absolute rock-bottom best rate and the lowest possible fees? That's the insider strategy we're breaking down next. Alright, let's pull back the curtain. What we're about to walk through isn't just a series of tips. It's a battle plan. A proven step-by-step strategy one call the lender gauntlet. Your goal isn't just to get a loan. It's to emerge from the other side with the absolute best deal possible, leaving thousands of dollars in your pocket, not the bank's. The first and most critical phase of this strategy happens before you ever speak to a single loan officer. This is the preparation phase. Think of it like a championship boxer studying fight tapes. You need to know your opponent, but more importantly, you need to know yourself. Lenders are going to scrutinize you, so you need to scrutinize yourself first. Step 1. Know your numbers cold. This means pulling your credit reports from all three bureaus, Equifax, Experian, and TransUnion. You can do this for free once a year. Go through them with a fine-tooth comb. Is there an error? A late payment that's incorrect? A collection account you already paid off? These are daggers to your interest rate. Dispute every single error. A 20-point jump in your credit score because you fixed an error can translate to a massive difference in the interest rate you're offered. Don't just know your score. Understand what's behind it. Step 2 in this prep phase. Calculate your own metrics. Don't wait for a lender to tell you what your loan-to-value ratio is. You do it first. Get a realistic estimate of your home's value from a few different online estimators, take a conservative average, and then do the math. Your current mortgage balance plus the new home equity loan you want, divided by your home's value. Is it under 80 or 85%? The lower, the better. You also need to calculate your debt-to-income ratio, or DTI. Add up all your monthly debt payments, mortgage, car loans, student loans, credit card minimums, and add the estimated payment for your new home equity loan. Divide that total by your gross monthly income. If that number is creeping above 43%, you're in a danger zone. Knowing these two numbers, LTV and DTI, before you apply transforms you from a passive applicant into an informed negotiator. You know your strengths and weaknesses before you even walk onto the field. The final piece of prep: assemble your dossier. Get a folder, physical or digital, and put everything in it. Your last 2 years of W-2s and tax returns, your last 2 months of pay stubs, your last 2 months of bank statements for all accounts, your mortgage statements. Having this ready to go shows lenders you are serious, organized, and easy to work with. It speeds up the process and makes you a premium candidate. Okay, your armor is on. Your intelligence is gathered. Now it's time to run the gauntlet. You are going to apply for a home equity loan with no less than 4 different lenders, and you're going to do it all within the same 14-day window. Why 14 days? Because credit scoring models typically count multiple inquiries for the same type of loan within a short period as a single event, minimizing the impact on your credit score. And you can't just apply to 4 big banks. That's a rookie mistake. You need to diversify your applications to create maximum leverage. Your 4 applications should look like this: one with a large national bank like a Chase or a Bank of America, one with a local or regional bank in your state, one with a credit union. This is non-negotiable. Credit unions are nonprofits and often have the best rates and lowest fees for their members, and one with a reputable online-only lender. Why this mix? Because each of these institutions has a different business model, different overhead costs, and a different appetite for risk. The online lender might have a slick process and a great rate but high fees. The credit union might have a slightly higher rate but zero origination fees and a more personal touch. The big bank might have a special discount because you're an existing customer. You won't know until you get them competing. Within a few days, you will start receiving official documents called loan estimates. This document is your Rosetta Stone. It is legally standardized, which means you can compare them line by line, apple to apple. This is where the real game begins. Most people just look at the interest rate and the monthly payment. You are not most people. You are going to look at the APR, the annual percentage rate. The APR includes not just the interest rate but also most of the fees, giving you a truer picture of the loan's total cost. A loan with a lower interest rate can sometimes have a higher APR because it's loaded with junk fees. Scan down that loan estimate to Section A, Origination Charges. This is pure profit for the lender. Is there a big origination fee or underwriting fee? That's a prime target for negotiation. Look at Section B, Services you cannot shop for. This includes things like the appraisal fee and credit report fee. These can vary wildly between lenders. One might charge you $600 for an appraisal, another might waive it entirely. That's a $600 difference you just found. Now you have your 4 loan estimates. You've laid them out, you've compared the APRs, the origination charges, and the third-party fees. You've identified your frontrunner, the one that looks best on paper. Let's call them Lender A. You've also identified your second choice, Lender B. This is the moment of truth. You call your loan officer at Lender B, and you say something very calm, very polite, but very firm. Hi Sarah. Thanks for sending over the loan estimate. I'm also looking at an offer from another lender that has a slightly lower APR. Mainly because their origination fee is about $1,000 less than yours. I really appreciate the service you've provided and would prefer to work with your team, but it's hard to ignore that kind of savings. Is there anything you can do to match that or get closer to it? And then you stop talking. Let the silence hang in the air. You have just done 3 incredibly powerful things. 1, you've shown them you are a savvy shopper by referencing specific numbers and fees, not just a vague, "Can you do better?" 2, you've complimented them and expressed a desire to work with them, making them want to keep your business. And 3, you've put the ball directly in their court. 9 times out of 10, that loan officer will say, "Let me talk to my manager and see what I can do." They have what's called lender credits, or the ability to waive or reduce certain fees to win a deal. They would rather make a little less money on your loan than get 0 money because you walked away. Once Lender B comes back with a revised better offer, what do? You take that new better offer and you call Lender C. You repeat the process. You are creating a downward pressure cascade on rates and fees. You're not being rude or demanding. You are being a smart consumer, using the free market to your advantage. Each lender knows they are in a competition for your business. You are simply forcing them to put their best and final offer on the table. By running this gauntlet, by being prepared, by diversifying your applications, and by systematically and politely leveraging each offer against the others, you are fundamentally changing the power dynamic. You are no longer just asking for a loan. You are dictating the terms under which you will accept one. This process might take an extra week, but that week of strategic work can save you thousands, or even tens of thousands of dollars over the life of your loan. You'll end up with a deal that 99% of homeowners never get, simply because they never knew how to fight for it. Now, once you have that winning offer in hand, that feeling of victory is incredible. But I need you to listen to me very carefully. The marathon isn't over. You've just entered the final, most treacherous mile. This is the part of the process that lenders hope you're too exhausted to pay attention to. It's called closing. And it's where tiny multi-thousand-dollar mistakes are buried in mountains of paperwork. You see, a verbal agreement or a fancy-looking offer sheet is one thing. The legally binding documents you sign are another. And if they don't match, guess which one wins? Every single time, it's the paper. Your most important weapon in this final stage is a document called the Closing Disclosure, or CD. You are legally entitled to receive this document at least 3 business days before you are scheduled to sign the final loan papers. This isn't a suggestion. It's federal law under the TILA-RESPA Integrated Disclosure Rule, or TRID. This 3-day window is your golden opportunity. It is your time to become a forensic accountant. Do not waive this right, ever. If a lender tries to rush you or says it's just a formality, that is a colossal red flag. When you get that closing disclosure, you're going to do something very specific. You're going to print it out, and you're going to print out the last loan estimate you received from that lender, the one you agreed to. You're going to sit down at your kitchen table with a ruler and a red pen, and you're going to compare them line by line by line. I'm not exaggerating. This is the moment of truth. First, check the big numbers at the top. Does the loan amount match exactly what you asked for? Is the interest rate precisely the rate you locked in? Is the monthly payment what you calculated and agreed upon? Is the loan term 10 years, 15 years, 30 years correct? If any of these are off, even by a fraction of a percent, you stop everything and call your loan officer immediately. A simple typo on an interest rate from 6.25% to 6.5% might seem small, but over 15 years on a $100,000 loan, that's a mistake that costs you thousands of dollars. But here's where the real games are played. Page 2 of the closing disclosure. This is the section detailing the loan costs and other costs. This is where junk fees are born and profits are padded. Your loan estimate will have a list of projected fees. Your closing disclosure has the final, real fees. And some of them are legally not allowed to change at all, while others have a strict 10% tolerance. Look for fees that have suddenly appeared or ballooned in price. Scrutinize things like underwriting fees, processing fees, document preparation fees, or courier fees? Are these fees significantly higher than what was on your loan estimate? Is there a vague loan discount fee, or points that you never agreed to pay? Lenders sometimes sneak these in, hoping you'll be so eager to get your money that you'll just sign whatever is put in front of you. Don't be afraid to challenge every single line item that doesn't make sense. Call your loan officer and say, "Can you explain this $400 administration fee? It wasn't on my original estimate." Their response will tell you everything. If they get defensive or dismissive, stand your ground. A legitimate fee has a legitimate explanation. A junk fee is often defended with jargon and pressure. Remember, until you sign, you are in control. They want your business more than you need their loan. You can still walk away. Knowing this and letting them know you know this gives you incredible leverage even at the 11th hour. The actual closing will likely happen at a title company or an attorney's office. The person sitting across the table from you is the closing agent or settlement agent. It is critical to understand that this person is not your lawyer. They are not your financial advisor. They are a neutral third party whose job is to ensure the paperwork is signed correctly, the money is transferred properly, and the new lien on your home is recorded with the county. They work for the transaction, not for you. They can explain what a document is, but they can't advise you on whether the terms are good or bad. That's your job, which you've already done by scrutinizing the closing disclosure beforehand. When you sit down at that table, you're going to see a stack of paper that could rival a phone book. It's intentionally intimidating. But you are not going to be intimidated. You will take your time. You will read before you sign. If the lender or closing agent tries to rush you, you will politely, but firmly say, "I need to review these documents properly. We can take as long as it needs." Bring your pre-vetted closing disclosure with you, and make sure the final numbers on the documents in front of you match it perfectly. Don't assume they do. Verify. Now, after all the ink is dry, one of the most powerful consumer protections in American finance kicks in, and it's something most homeowners have never even heard of. It's called the right of rescission. For any home equity loan or HELOC taken out on your primary residence, federal law gives you a 3-day cooling-off period after you sign the papers. This means you have the absolute, no questions asked right to cancel the entire transaction for any reason or no reason at all. This is your ultimate safety net. Maybe you went home and realized you were pressured into a bad deal. Maybe you found a mathematical error you missed. Maybe you just have a bad feeling in your gut. It doesn't matter. You can cancel. The clock starts ticking the day after you sign the closing documents and ends at midnight on the third business day. Business days include Saturday, but not Sunday or federal holidays. At your closing, you will be given 2 copies of a document called the Notice of Right to Cancel. To exercise your right, you must notify the lender in writing. You can mail, email, or fax this notice. I strongly recommend sending it via certified mail with a return receipt, so you have ironclad proof of when you sent it. Once you send that notice, the deal is dead. The lender must return all fees you've paid within 20 days, and they must release the security interest they placed on your home. It's as if the whole thing never happened. This right is so powerful because it removes all the pressure from the closing table. You know that even if you sign, you have a 3-day window to back out, cost-free. And because of this rescission period, your loan won't actually fund immediately. The lender will wait until that 3-day window has closed. Once it passes on the 4th business day, they will disburse the funds. For a home equity loan, this means the lump sum is wired to your bank account. For a HELOC, this means your line of credit is officially open, and you can begin drawing from it. You've done it. You navigated the application, shopped lenders, fought for the best deal, dissected the closing documents, and survived the final signing. You've successfully unlocked the equity in your home, turning a number on a piece of paper into real, accessible cash. You've passed the test. But now a new and perhaps more important question emerges. You have the key. You've opened the vault. But what you do with what's inside will determine whether this was one of the smartest financial decisions of your life, or a doorway to a trap that could cost you everything, including the home itself. Unlocking the money is the easy part. Using it wisely is the real challenge. And that's where we're going next. So what separates the two paths? What makes tapping your home's equity a brilliant strategic move versus a catastrophic mistake? It's not the loan. It's not the bank. It's you. It's the why. It boils down to a single fundamental question. Are you using this money to build something of lasting value? Or are you using it to simply consume? Think of it this way: you can use a hammer to build a house, Or you can use it to smash a window. The tool is the same. The intent and the outcome are worlds apart. The wisest use of home equity is almost always to acquire an asset or eliminate a high-cost liability. Let's start with the most common and often smartest play: debt consolidation. Imagine you're juggling 3 high-interest credit cards. One is at 22%, another at 25%, and a store card is sitting at a staggering 29%. Every month, you're throwing money into a bonfire of interest payments. You're barely touching the principal. You're running on a financial treadmill, getting nowhere. Now, you take out a home equity loan at, say, 7% or 8%. You use that lump sum to wipe out all 3 of those credit cards in a single day. Instantly, you've traded a 25% average interest rate for an 8% rate. Your single monthly payment is now drastically lower than the 3 combined payments you were making before. But more importantly, a much larger portion of that payment is now going toward the principal. You're no longer just feeding the beast. You're actually paying down your debt. You've used a lower-cost, structured loan to eliminate high-cost, unstructured, and soul-crushing debt. You've created immediate cash flow and a clear path out of the hole. That is a strategic, value-creating move. The next classic use is investing back into the asset itself, home improvement. But this is where you have to be careful. Not all renovations are created equal in the eyes of the market. The goal is to choose projects with a high return on investment or ROI. These are the upgrades that don't just make your home nicer to live in, but actually increase its market value, sometimes by more than the project cost. Think about a kitchen remodel. A modern functional kitchen is the heart of the home and a massive selling point. A mid-range kitchen renovation can often recoup 80% or more of its cost at resale. The same goes for bathrooms. Updating a dated bathroom is one of the safest bets you can make. Then there's curb appeal. A new front door, updated landscaping, or fresh exterior paint can dramatically change a buyer's first impression and add real value for a relatively low cost. Adding square footage, like finishing a basement or building a functional deck, is another powerful way to increase your home's worth. You are literally turning your equity into more equity. But then there's the other side of the coin, the low ROI projects. Installing a swimming pool is a classic example. It might cost you $60,000, but it might only add $20,000 to your home's value. And in some markets, it can even be a deterrent for buyers who see it as a maintenance and liability headache. Highly personalized, taste-specific upgrades, like a custom home movie theater with purple velvet walls or an exotic tile mosaic in the entryway, might be your dream, but they probably won't be the next buyers. These are lifestyle choices, not financial investments. And that's okay. You're allowed to use your money to enjoy your life. But you have to be brutally honest with yourself. You are trading equity for enjoyment. You are consuming it, not investing it. Another powerful, long-term investment is in yourself. Using home equity to pay for a college degree, an MBA, or a professional certification that can significantly boost your earning potential over your lifetime. This is turning your home equity into human capital. The financial return might not be immediate like a kitchen remodel, but over a 30-year career, an advanced degree could generate hundreds of thousands, if not millions, in additional income. It's a long-term play that bets on your most valuable asset, you. Now let's walk down that other path. The path to the trap. This is where you use your home equity not to build, but to burn. The number one mistake is funding an unsustainable lifestyle. Your home is not a piggy bank. A HELOC is not a magical credit card. When you use your home's equity to pay for lavish vacations, a brand new luxury car that depreciates the second you drive it off the lot, designer clothes, or expensive dinners, you are committing a cardinal sin of personal finance. You are taking the most stable, powerful asset you own and liquidating it for fleeting experiences and depreciating goods. It's like taking the bricks from your home's foundation one by one to fuel a bonfire. It feels warm for a moment, but you're destroying the very structure that keeps you safe. When the vacation is over and the car has its first scratch, the loan payment will still be there. Month after month, a constant reminder of the equity you'll never get back. The second doorway to the trap is using your equity for high-risk, speculative investments. You hear about a hot stock, a new cryptocurrency, or a can't-miss investment opportunity. So you pull out $50,000 from your home and roll the dice. This is gambling, plain and simple, but with the worst possible stakes. The interest on your home equity loan is guaranteed. You will have to pay it back. The returns on your speculative bet are anything but. The market could crash. The crypto could go to zero. You could be left with a massive new debt payment attached to your house and absolutely nothing to show for it. You've taken on guaranteed risk for a phantom reward. If you want to invest, use your savings, use your disposable income. Never ever bet the house. And perhaps the most insidious trap of all is using home equity to cover up a fundamental budgeting problem. You're consistently spending more than you make. So, to make ends meet, you open a HELOC and use it to pay for groceries, gas, utility bills just to get through the month. This is the financial equivalent of putting a Band-Aid on a gaping wound. It doesn't solve the problem. It just hides it while you bleed out. The equity provides a temporary cushion, a false sense of security. But the underlying issue, the overspending, is still there. Eventually, the line of credit will be maxed out. And when it is, you'll be in a far worse position than before. You'll have the same spending problem, no more equity to draw from, and a massive new loan payment that you absolutely cannot afford. This is the fast lane to foreclosure. So before you sign on that dotted line, before you unlock that wealth, you must ask yourself 4 critical questions. Be honest. Your financial future depends on it. First, is this an investment or an expense? Will this money be used to create lasting value? By increasing my home's worth, eliminating high-interest debt, or boosting my earning power? Or will it be consumed on something that will be gone or worthless in a few years? Second, can I truly afford the new payment? And not just today with your current income. Stress test your budget. What happens if the variable rate on your HELOC skyrockets? What if you or your partner loses a job? If the new payment would stretch your budget to its breaking point, you cannot afford it. Period. Third, is this a genuine need or a want in disguise? A new roof to stop a leak is a need. A third bathroom with a jacuzzi tub is a want. We are experts at convincing ourselves our wants are needs. You have to be the ruthless auditor of your own desires. Is this desire worth putting your family's home on the line? And finally, question 4. Have I exhausted all other, less risky options? For a smaller project, could you save up for 6 months? Could you use a 0% APR introductory offer on a new credit card and pay it off aggressively? Could a standard personal loan, while having a higher interest rate, be a safer option because it doesn't put your house up as collateral? Don't default to home equity just because it's the biggest pot of money available. Your home is the financial and emotional center of your world. The equity you've built is a testament to years of hard work, sacrifice, and smart decisions. It's a powerful tool, a reserve of wealth that can be used to build an even better future. But like any powerful tool, it demands respect, foresight, and discipline. It can be the ladder that helps you reach your highest financial goals, or it can be the shovel you use to dig a hole you can never escape. Unlocking it is easy. The real work is in the wisdom of its use. Choose to build. Choose to invest. Treat the equity in your home with the profound respect it deserves, and it will serve as the bedrock of your family's prosperity for generations to come. The choice is yours. Make it a wise one.